Hello, my fellow investors, and welcome back to the second day of this massive earnings week, guys. Oh my god, yesterday we covered Verizon, Microsoft, Johnson & Johnson, and Union Pacific, and I still missed a few. So we're going to take a look at those at a much later date, probably in the weekend. But today, guys, it is Wednesday, and we have two of the big ones, Boeing and Tesla. And those are the two that I would actually like to cover today, as well as AT&T and NextEra Energy, but I think I may leave those for, again, later in the day. Let's get started with the first company being the company Boeing. And this company has had such an insane, just complete story. Within like 2020 or like even earlier, like 2019, they have had controversy after controversy. They used to have a dividend, now they don't anymore. It's just complete insanity when it comes to this company. But the good thing is that they are a duopoly, and Airbus, which is their competitor, is very, very difficult to invest in. So they kind of have like a semi-duopoly, kind of a semi-monopoly when you think about it. But nonetheless, guys, they did have earnings, which came out really, really bad. EPS normalized actual came in at negative $1.75. Negative $1.75. That was a miss by $1.95. EPS gap actual $1.06, missed by $1.71. That's insane. Revenue actual $19.98 billion. At least that one is in the positive, but it was a miss by $116.63 million. Looking at the earnings summary, and of course, guys, like always, this will be linked in the description below if you guys would like to read the entirety of it, because it is 14 pages and I'm not going to cover all of it, guys. It's just not feasibly possible. So I'm going to go over a few of the points that I like, and then if you guys would like to read it for yourself, which I highly suggest you do, because this is not financial advice. And remember, every investment is the present value of all future cash flow. You can lose money when investing into anything. Yes, even blue chips. You are susceptible to losing everything. So please do your own due diligence, read the earnings report, read their 10Ks, learn everything you can about the company before you invest in them, just because you do not want to lose your hard-earned money that you work to get. But I digress. Let's come over here into their actual earnings report. Fourth quarter, we generated $3.5 billion of operating cash flows and $3.1 billion of free cash flows. You know, okay, they missed on a lot, but you know what? At least they're putting the free cash flow front. So I really do like that, but their earnings are still garbage. Cash and marketable securities of $17.2 billion. Certification efforts continue on 737-7 and 737-10. Delivered 152 commercial airplanes and recorded 376 net orders. Full year for 2022 generated $3.5 billion in operating cash. Why is that the same? Why is that the same as the fourth quarter? What? Generated 3.5 billion operating free cash flow? Generated 3.5 billion operating free cash. What? There's something wrong there. And 2.3 billion, well, that one's different, but it's less. And 2.3 billion of free cash flow. Delivered 480 commercial airplanes and recorded 808 net orders. Total company backlog grew 404 billion, including over 4,500 commercial airplanes. And they even put the outlook here as well. I actually really like the way that this is set up. Every point that we like to just summarize is right there. Outlook for 2023, reaffirming guidance 4.5 billion to 6.5 billion of operating cash flows and $3 billion to $5 billion free cash flow. Okay, I want to see what the comparison is to that of 2021. So let's come down here. Actually, no, before we do that, let's see what the CEO had to say. Quote, we had a solid fourth quarter in 2022, proved to be an important year on our recovery. Boy, do you need a recovery, said Dave Calhoun, Boeing President and Chief Executive Officer. Demand across our portfolio is strong, and we remain focused on driving stability in our operations and within the supply chain to meet our commitments in 2023 and beyond. We are investing in our business, innovating and prioritizing safety, quality, and transparency in all that we do. While challenges remain, we are well positioned and are on the right path to restoring our operational and financial strength and your credibility. Because what happened in 2020 with the whole crash of, like, I forgot what it was. Was it the 737 Max? I think it was something with like the way that the plane was shaped or something like that. That completely destroyed their credibility. And then add on top of that, COVID hit too. It was just, oh my god, this company has just been on a roller coaster. But now let's actually come over here and compare some of these numbers to that of 2021. We got revenues 14.7 billion to 19.98 billion, so $20 billion billion. That was an increase when it comes to the fourth quarter revenue of 35% and a 7 increase when it comes to the full year. Looking at the gap, we got loss from operations. They went from negative $4.2 billion to negative 353. Okay, so they're at least bringing that back. They do not have a percent change for that because it's in the negatives. Operating margin went from negative 28.2% to 1.8%. Net loss 4.2 billion to negative 663 million. All of these, by the way, guys, are in the negatives. Okay, I'm just gonna straight up say it. Unless they're in the positives, just assume that I'm saying negative numbers at this point. So yeah, net loss went from 4.2 billion to 663 million. Loss per share $7.02 to $1.06, and operating cash flow, that were in the positives, $760 million to $3.45 or $3.46 billion. When it comes to the non-GAAP, we got the core operating loss of negative 4.5 billion to negative 650, core operating margin of negative 30.7% to negative 3.3%, and core loss per share negative $7.69 to negative $1.75. Guys, they are just, oh dear lord, they are hemorrhaging money overall. Now let's come over here into table 2 to take a look at the free cash flow. I'm really interested in this because, again, every investment is the present value of all future cash flow. So we got here fourth quarter 2021, $494 million. By the way, positive right now, okay? So $494 million in the fourth quarter in 2021, and then in 2022, $3.13 billion. Okay, not too shabby. And then the full year, they went from negative $4.4 billion in 2021 to positive $2.3 billion. Not bad, guys, not bad. Operating cash flows improved to $3.5 billion in the quarter, reflecting higher commercial deliveries and timing of receipts and expenditures. Okay, not bad. But that's pretty much all that I wanted to see when it comes to this, guys. Now let's actually come over to the discounted free cash flow to take a look at this at a much bigger range. We got the ticker symbol for BA, market cap of $126.75 billion, a PE of an A. Oh boy, you know what this means, right? They got negative net income, which we kind of already saw. The current share price is a whopping $212.68. And if we actually take a look at this, they're up 4.20, percent on the 1 year, and on the year to date they're up almost 9%. That's actually really surprising. Now I do want to show you guys this. Take a look at this 5-year graph though. They're down 38.03%, and you can tell, like, right here, even before COVID hit, like the whole wave started to hit, which happened at around like March 20th, at around that time. At around February, they crashed from $344 to, well, the low point of $101. And take a look at this 52-week range. Their 52-week low is $113.02. So that's not too far off from all-time lows, at least on the 5-year, which was, again, $101. And their high is $223.23. We are at the higher end of this scale. Now, what the stock did after earnings, well, it kind of went nowhere. They had earnings pre-market, and the stock only rose 1/3% during trading day, and after market, it went up another 0.12%. That's it. So not really anything when it comes to this. It really is just subpar. Their earnings just weren't there, right? Not at all. Now, they do not pay out a dividend. However, they used to. But again, the whole controversy of the 737 MAX, this just became a whole ordeal. They were actually taking, if I remember correctly, they were taking so much debt, oh dear Lord, to pay out that dividend that at one point I was just like, I don't want to invest in this company. I got really close to invest into this for like a dividend perspective. And back then, I didn't even know anything about like cash flows or anything like that. And something told me, I was just like, that payout ratio, man, it's just way too. I think it was like upwards of like 120% or something. It was crazy. And I didn't do it. Thank God I didn't do it. So with all of that said, all of this free cash flow is going straight into themselves. But take a look at this, guys. The free cash flow, not that good, in my personal opinion. Now let's take a look at some fundamentals. Net income, we got 5 years ago of $10.46 billion to 1 year ago of negative $8.44 billion. Now, before we go on, 1 year ago, guys, it is 2022. 2 years ago is 2021. 3 years ago, it is 2020. So just keep that in mind that this value over here, the lowest value, is 2020. But take a look at this. This is a massive decrease on the 5 year of 181%. And okay, exclude 2020. 4 years ago, they went into the negatives too. 2 years ago, okay, this was post-COVID, but still, they went to the negative. And 1 year ago, 2022, you would think, you know, people are flying more, you know, all of this is happening. We're kind of getting out of it now. They were more in the negative than they were, what, 2 years ago. So I don't necessarily know. That's why I gave this thing a 0%. This is awful. This is awful net income. And the free cash flow isn't getting any better. 5 years ago of 13.6 billion to 1 year ago of negative 347 million. That is another decrease of 103% with an average of negative $3 billion. Wow. Again, something similar to that of the net income, whereas like from 4 to essentially 1 year ago, they're in the negatives. Now, I gave this a 5% for one reason and one reason only. They got a little bit closer to being positive 1 year ago. That's about it, guys. But honestly, this is awful. This is awful company as it currently stands. We're looking at the revenue. This one came in as a shock because normally revenue is like the only one that like continues to pump up. Guys, their revenue is crashing. $101.13 billion 5 years ago to 1 year ago of $61.4 billion. That is a decrease of 39.26%. Yeah, that's really bad. That's really bad. They had a little bit of an uptick going from 3 to 2 years ago, but from 2 to 1 year ago, they came down by $1 billion. I gave this a 15%. This is awful. Total assets minus total liabilities. Remember when I said that they were piling on debt to pay out that dividend? Well, here you go. Right there it is. Right there. Yeah. Their worst year was 2 years ago, believe it or not. By the way, this graph, it is a little bit misleading. I hate when the year turns over because all of these numbers just don't make any sense. So now the current year, unfortunately, it is taking 2022, but 1 year ago, it is technically December of 2021. So this is December of 2021, 1 year ago. 2 years ago, it would be December of 2020. So again, terribly sorry, but it's just the way the numbers are when it comes to like the new year. It happens every single time and I hate it. But you can see, complete crashing. It just completely crashes into the negatives. In fact, average total assets is 135.8 billion. Average liabilities is more. Average liabilities is 147.5 billion. That is a difference of negative $11.7 billion. I gave this a 0%. That's absolutely atrocious. And if you guys saw this, guess what? This looks even worse. So you got negative free cash flow. And on top of that, you have negative, well, you have the liabilities becoming a lot higher than the assets. What do you think the cash flow minus liabilities is going to look like? Awful as well. Now, they did have one uptick, and that was from 2 years ago to 1 year ago, going from negative $174.61 billion to negative $153.7 billion. Guys, I gave this a 10%, mainly because that uptick right there, it's pretty big, right? $20 billion or so. But look at this. Average cash flow minus the average total liabilities, negative $141.65 billion. Yeah, 10% I think is fair enough. Looking now at that shares outstanding, this one actually came as a surprise to me because looking at this in the 5 years, guys, we got 567.6 million shares to today of 595.6 million shares. And by the way, this current year, it is as of 2022. So just keep that in mind, okay? 1 year ago and the current year, it is the same year, 2022. I should probably do that for the rest of the graphs. I'll do that for Tesla once I do that. But regardless, guys, this one's actually not as bad as I would think. They did increase shares, don't get me wrong. They did have a little bit of a downtick from 5 to 4 years ago, but ever since then, they just kept increasing. But if you take a look at this, going from 567.6 to 595, it's not that much. I mean, it was less than 5% on the 5 year, but they did increase it 1.14% from the previous year to the current year. So that's why I'm giving it a 10%. They are slowly diluting you into oblivion, essentially. And when it comes to the cash equivalents, they got 13.5 billion. With an average of $9.21 billion. And now, looking at the total grades, well, I mean, we gave this several zeros. So, yeah. Gave them the income, guys, 0%. Free cash flow, 5%. Revenue, 15%. Asset minus liabilities, 0%. Cash flow minus liabilities, 10%. Shares outstanding, 10%. Overall grades are 7%, guys. I mean, is there really anything else for me to say? It's just not good. It really, really just isn't good from a fundamental perspective. But a company that isn't doing good isn't necessarily worthless. It's still worth something. So let's make low, medium, and high assumption using a revenue growth of 8, 9, and 10% and a predicted share buyback of -6. The negative just means that they're issuing. Remember, we have seen that they have issued around almost 5% in the past 5 years. So I went -6 for the worst, -5 for the median, which is on par with what they have been currently doing, and -4 for the best. Guys, I'm getting these revenue growths from Seeking Alpha's growth tab. They have it at 11.63% when it comes to the forward. I personally don't think that they'll do that, so I went a little bit lower at 8, 9, and 10, as I just said. With these assumptions and a required rate of return of 10%, This puts me between the target share prices, not adjusting for debt, of $134.12 to $146.27. Adjusting for debt, this comes down hard. I mean, we saw the amount of debt they have. It's insane. $87.50 to $98.73. Adding a margin of safety of 5, 10, 50%. This puts me between $74.38 to $93.79. So you had an opportunity to buy this at a pretty decent price at the 52-week low when it got to like $113 or so. But as it currently stands, it is very, very expensive all across the board, at least from a discounted free cash flow standpoint. Obviously, you guys should have these calculators and make your own assumptions. At the end of the day, as I said, this is not financial advice, and every investment is the present value of all future cash flow. All I'm asking for in return, guys, is just like, subscribe, comment. It really does help with the algorithm on YouTube. Now, we're going to move into Tesla now. I'm going to make this one video, but for the next one, I'll make it a separate video on its own. But I really wanted Boeing and Tesla to be on the same video. So let's head over now to, oh dear Lord, Tesla. Here we go. And here we are, guys, with the company Tesla. Now, I actually really did this company a couple weeks ago, actually. And like always, you know, this company is a cult company. It just is. It's a cult stock. It was the bread and butter to a lot of people in the 2020 and 2021 stock market, just complete irrationality of stocks only go up, right? And a bunch of people came into notoriety because of this company. I'm not going to mention names, but as of recently, this company has taken a turn for the worse. Now, you can blame Elon Musk because of like the whole Twitter thing, but at the end of the day, guys, that's not an excuse when it comes to why the stock price is going down. It really, really isn't. So the fact of the matter is that I'm going to say the exact same thing I just said in my previous video when it came to this company. And I can't wait to see a couple of people in the comment section to tell me that I'm wrong, because it happens every single time. But to be fair, I've already been proven right when it comes to this company. It has fallen a significant amount already. And I personally believe that even at the current share price, it's still expensive. It's still expensive. And you know what? I'm going to show you guys an article of somebody else thinking the exact same thing. Because unfortunately it is. Does this mean that I think the company's bad? Absolutely not. Does this mean I hate Elon Musk? No. Elon Musk is one of the biggest trolls on the planet, and I love that. I absolutely adore that. But you have to separate the stock from the company. And unfortunately, the stock is expensive as it currently stands. So here we go. Let's dive into these earnings reports and see what they did. Now, unfortunately, when it comes to Seeking Alpha, they do not have this updated yet, but the EPS normalized estimate came in at $1.11, EPS gap estimate $1.05, and a revenue of $24.32 billion. So now let's jump into their actual earnings. Now, they have it kind of weird. They have it in like a PowerPoint kind of way, but nonetheless, we can still read them. Starting off with the highlights: profitability, 16.8% operating margin in 2022, 16% in Q4. $13.7 billion GAAP operating income in 2022, $3.9 billion in Q4, $12.6 billion GAAP net income in 2022, $3.7 billion in Q4, $14.1 billion non-GAAP net income in 2022, $4.1 billion in Q4. When it comes to the cash, we got operating cash flow of $14.7 billion, free cash flow of $7.6 billion in 2022, operating cash of $3.3 billion, free cash flow of $1.4 billion in Q4, and $1.1 billion increase in our cash and investments in Q4 to $22.2 billion. Operations, we got 6.5 gigawatt hours of energy storage deployed in 2022, up 64% year over year. Record vehicle deliveries of 1.31 million in 2022. We got to over here the summary. Q4 2022 was another record-breaking quarter, and 2022 was another record-breaking year. In the last quarter, we achieved the highest quarterly revenue, operating income, and net income in our history. In 2022, total revenue grew 51% year over year to $81.5 billion, and net income gap more than doubled year over year to $12.6 billion. And we also got some outlooks when it comes to 2023. As we progress into 2023, we know that there are questions about the near-term impact of uncertain macroeconomic environment, and in particular with rising interest rates. The Tesla team is used to challenges given the culture required to get the company to where it is today. In the near term, we are accelerating our cost reduction roadmap and driving towards higher production rates while staying focused on executing against the next phase of our roadmap. So overall, they did really, really good. And I know that we don't have it updated yet for Seeking Alpha. However, we do have an earnings news article here. Tesla non-GAAP EPS of $1.19 beats by 8 cents. Revenue of $24.32 billion was in line. So if we come back over here, guys, to this earnings, we could see that, yeah, when it came to the non-GAAP EPS, they beat it by 8 cents, right? $1.11, they got $1.19. Awesome. But revenue came in line. That to me, guys, for the kind of company that people say this is, that to me isn't record breaking. I mean, we saw the exact same thing with Microsoft. Microsoft beat earnings by like a penny, and I believe they lost in revenue. And we saw a massive jump of 4% in Microsoft and then just a crash afterwards. So the fact of the matter is that for all the hype this company gets, I was expecting a lot more. Like, I was really expecting, you know, for them to beat, you know, by like $2 and the revenue to be like $100 billion, quadrillion dollars or something like that. Obviously, I'm exaggerating, but the point is that when the revenue comes in line to analyst estimates and non-GAAP EPS beats by 8 cents, yeah, I mean, that's pretty average, right? That's honestly pretty average. Tesla is a car company, and to those people who say no it's not, yes it is. A majority of all of the revenue comes from cars. Only a small portion of it comes from like their solar section. It is a car company. Do they use high tech in their cars? Yes, but so does Toyota, so does Ford, so does pretty much every other company that exists. So that's not really an indicator that this is a tech company, as some people like to call it. It's not a tech company, it is a car company, end of story. So now with that said, let's actually jump into the numbers. I would go into the CEO's comments, but Elon Musk did not say anything. I can't really read if it didn't say anything. But anyways, guys, we got over here total revenues. We got $17.7 billion in Q4 2021 to $24.32 billion in Q4 2022. That is an increase of 37% year over year. Not bad. Operating expenses went from $2.23 billion to $1.87 billion. That's actually a decrease of 16%. Income from operations, we got $2.6 billion to $3.9 billion, increase of 49%. Operating margin, 14.7% to 16%. That is an increase of 129 basis points. Looking at their net income attributable to common stockholders GAAP, we got $2.3 billion to $3.7 billion, increase of 59%. And net income attributable to stockholders non-GAAP, that is $2.88 billion to $4.11 billion, increase of 43%. And of course, when it comes into the free cash flows, this is the one I like to see the most. We got net cash provided by operating activities. They went from $4.58 billion in 2021 Q4 to $3.27 or $3.28 billion in Q4 of 2022. That's actually a decrease of 29%. Capital expenditures went from negative $1.8 billion to negative $1.85. Okay, sorry about that. Negative $1.81 billion to negative $1.858 billion. That is an increase, a slight increase in their capital expenditures of 3%. And now looking at the free cash flow, guys, free cash flow. All I'm saying, I'm just reading numbers here. They went from $2.78 billion in Q4 2021 to 1.4. I love how they did 420. I just know it. Why? Okay, I think they planned that. Okay, sorry. I'm digressing here. I'm so sorry. Free cash flow. Q4 2021, $2.78 billion to Q4 2022, $1.42 billion. Guys, that is a decrease in the free cash flow on year over year of 49%, at least from 2021 to 2022. And by the way, to prove to everybody that says Tesla's more than a car company, okay, let me actually prove to all of you guys that it is a car company. Take a look at this. We got over here the operational summary. Essentially, how much cars did they produce as well as did they deliver? And we also got over here solar. So let's compare some of these numbers, shall we? I'm only going to see Q4 of 2022. Take a look at this. Total production Q4 of 2022, 439,701 cars produced. That is an increase of 44% year over year. How much of them were delivered? By the way, this is looking at the Model SX deliveries and Model 3Y deliveries. And take a look at this. How many of them were delivered in Q4 2022? 405,278. 31% year over year. Okay, that's a lot of big numbers, right? 405,000 cars. Okay, not bad. Let's take a look at the solar. Okay, we got over here the solar deployed in Q4 2022, 18% increase year over year. Storage deployed Q4 2022, 2,462. That is up 152% on the 1 year, but compare these numbers to the cars produced and the cars delivered. It doesn't even come close. Guys, Tesla is a car company. End of story. Do they make other things? Yes. Do those other things bring in revenue? Yes. Does it compare to what they make in revenue when it comes to cars? No, it does not. I really do hope that people see that Tesla is a car company. Alright guys, now let's come into the calculator. Oh boy, here we go. We got the ticker symbol for TSLA, market cap of $452.56 billion. A PE, 44.49. Guys, just this alone should tell you that this is expensive. Current share price of $144.43. I'm going to show you guys why this is an insane share price in just 1 second. On the 1 year, guys, they are down 52.82%. Year to date, they're up 33.61%. What? What just happened there? That's insane. 52-week ranges, guys, is $101.81 to $384.29. Now, okay, Tesla had earnings post-market. Take a look at this. $144 was at close, as we saw. Aftermarket, up 5.5%, $7.93 to $152.36. Why is this important? Okay, take a look at this. I'm going to bring this now, guys, into the 1 month graph. 1 month ago, I kid you not, 1 month, actually less than 1 month ago, on January 3rd, Tesla was $105. Tesla hit their lowest point 3 weeks ago. This 52-week low of $101.81 occurred 3 weeks ago. And from January 3rd to January 26th, when you guys see this, Tesla just rose from $105 to $152. How is that not just insane? Seriously, how is that not just insane? That's absolute lunacy. Absolute lunacy. And in fact, you guys did see that PE is absolutely massive, right? It is really expensive just from a PE perspective. And if you guys have seen my previous videos, you'll know that I'm going to say the exact same thing. This company, guys, is overvalued. And just to prove my point, guys, I actually saw this article earlier today. Tesla is egregiously overvalued. I didn't even use that word. Egregiously overvalued. Not sustainable in the long term. Ahead of earnings results set to come out after the closing bell, analyst Craig Irwin questioned the current valuation of Tesla, arguing that Elon Musk EV maker, which has already fallen more than 50% on the 1 year, probably that's what that says. Guys, this guy, Craig Irwin, he's right. This company is very much overvalued in comparison to what this company is bringing to you as an investor. And I'm going to prove to you guys exactly what I mean once we go over those fundamentals. Now, they do not pay out the dividend, which is very, very notable, but it's actually a good thing because they are more oriented to being a growth company. And don't get me wrong, they are growing, but how much is that growth worth, right? That's kind of the question that you have to ask yourselves over here. And on top of that, because they don't pay out the dividend, all of their cash flow is going straight into themselves. And from what you guys could see, the 5-year average free cash flow, it is lower than the last year's free cash flow. So they're at least growing that. All right, guys, now let's head into the fundamentals. Starting off, we got the net income 5 years ago of negative $976 million to 1 year ago of $11.2 billion. That is a massive increase of 1,247%. Now, we did have some negative numbers here, guys, but they have been increasing it within the past 5 years. The main thing that I don't like about this is that they had a massive jump from 3 to 2 years ago, going from 721 million to 5.52 billion. And then from 2 years ago to 1 year ago, 5.52 billion to $11.2 billion, guys. That's the reason why I'm giving this a 40%. Not because it is not increasing, it's because of the massive outliers that you see from 3 to 2 to 1 year ago. When it comes to the free cash flow, we see something very different, though the margin of this jump, it is a little bit better. We got 5 years ago, we got negative $221 million to 1 year ago of $8.9 billion, increase of 4,133% with an average of $3.5 billion. Again, they have been increasing this really, really solidly. I like that. My main issue is this jump from 2 to 1 year ago. That's not as big as the one we saw here, and the jump from 3 to 2 years ago wasn't as big either, so I'm giving this a 60%. Looking at the revenue, we see something similar. No negative numbers though, so I gave this one a little bit higher. 5 years ago of $21.46 billion to 1 year ago of $74.86 billion. Increase of almost 250%. Again, big issue is that they made a massive jump from 3 years ago to 2 years ago, and then from 2 years ago to 1 year ago, but I'm still giving it a 70%. In the total assets minus the total liabilities, this was looking really good too. They have been positive within the past 5 years and increasing as well. My main problem with this is, well, they did have a pretty big jump here from 4 to 3 years ago, but honestly, it really isn't that bad. Average total assets, it is $59.5 billion. Average liabilities is $30.4 billion. Doing this difference, we get $29.12 billion. I gave this a 65 originally. I'm changing my mind on this. This right here from 4 to 3 years ago was a really long time ago. I'm going to increase this to a little bit higher to, I would say, at around like a 70% or so. I think that they fairly deserve that 70% from me. Looking now at the cash flow minus the liabilities, this one is actually kind of looking good in the sense that they're not bringing it lower, right? Their lowest point was, I believe, right here 3 years ago, but as you can see, their average is at around the negative $25 billion. And they have instances where they have brought it up, right? And from 3 to essentially 1 year ago, they have been bringing it back up. Average cash flow minus the average total liabilities, we got negative 24.9. Let's just say negative $25 billion. I'm giving this a 75%. And now for the one that people do not understand, and the one that I constantly criticize Tesla for, and that is the shares outstanding. Guys, shares outstanding, it is basically how many shares there are out there for you to buy, okay? Companies issue shares for a multitude of reasons. Growth companies tend to issue shares because instead of taking on debt, they get capital by issuing shares. The problem with that is that if you're an investor of this company and a company continue to issue shares, they're diluting you. And the more they dilute you, the value of the shares that you currently hold lose value. So you do not want a company to be issuing shares. In the form of Tesla, they went from 5 years ago of 2.59, or let's just say 2.6 billion shares, to today of 3.16 billion shares. That is an increase of 22% on the 5 year, and in just 1 year, almost 2%. I'm giving this a 0%. There hasn't been a single year where they bought back. There hasn't been a single year where they kept it the same. They're just constantly diluting you. So I'm giving this a 0%. Now, I have to bring up a beauty of a comment that I got in my previous Tesla video. And I'm going to shout you out because I think you deserve to be heard. I really would like for everybody to see your beautiful comments. We got over here, guys, the commenter Greg Faison. He commented this on my stock analysis for Tesla back a month ago. He put in 2 notable comments that I would just like to point out. Quote, "Man, you are really making a huge mistake. It's not dilution, it's a split. First was 5 for 1, second 3 for 1. I've been following Tesla since IPO in 2010. Invest and hold, must screws up all the time. Stock goes up and down. I'm holding it at least until 2023. And then he continued on to say, you are wrong on understanding the difference between dilution and split. Just Google definition on both. Buyback is completely different. Tesla has never done it yet. Last dilution, I'm guessing he's referring to dilution. Okay. Tesla has never done it yet. Last dilution Tesla had was in September of 2020, when the stock went down from 500 to 330 after 5 for 1 split. There's a lot for you to learn on the market. I'm guessing he's saying he's on the market since 2003, following Tesla since 2010, July of 2010. Okay, so I'm going to do exactly what you told me because you clearly know a lot more about this. I mean, you've been in the market since 2003, so you clearly know more about this. So I'm going to take your word and I'm going to Google this. So let's look up, guys, share dilution. Right over here, Investopedia. When the company issues additional shares of stock, it can reduce the value of the existing investor shares and their proportional ownership of the company. This common problem is called dilution. It is a risk that investors must be aware of as shareholders, and they need to take a closer look at how dilution happens and how it can affect the value of their shares. Okay, so very simple. When a company issues additional shares. Perfect. Now let's take a look at the stock split. Same exact source. Stock split. A stock split happens when a company increases the numbers of its shares. Okay, so we're in the same page as the one before, to boost the stock's liquidity. Although the numbers of shares outstanding increases by a specific multiple, the total dollar value of all shares outstanding remains the same because the split does not fundamentally change the company's value. Okay, so you're saying that Tesla has never done a dilution? It's always a stock split. Okay. Now, obviously, you're the one that knows the most about this since you've been in the market since 2003, but I would just like to show everybody else an example of the difference between share dilution as well as a stock split. So let's make this hypothetical company that the market value of the company, it is $100. Okay. Again, I'm making the number simple. With a market value of $100, you own the single share of this company. You have a total shares outstanding of 1 share. Okay, so you own that total share. The share price, it is the market value divided by the shares outstanding. Obviously, if you have 1 share, then the share price that you hold, it's worth $100. Now let's say you issue 2 shares. Okay, so you decide to split up that 1 share that you have, you make it 2. Now the share price is $50. Okay, now each of these shares that you have over here, each of them is worth $50. You can hold one and you can sell the other one for $50, but the one that you have is worth $50. Okay, you split it up again. You split those 2 up to now 3 shares. You create an extra one. Now the share price is $33.33. You do the same thing now, bring it to 4. Now the share price is $25. And you bring it up to 5. Now the share price is $20. If I'm an investor in this company and I do this, I issue shares, the value of each individual share is going down if I do not buy more of the shares in order to keep the value up. This is dilution over here, okay? Now let's take a look at stock split. We're going to use the exact same example, market value of $100, and right over here we got the company as it was up there in the non-stock split scenario. But now let's say that we do a 2-to-1 stock split. Just keep the number simple. Now we multiply the total numbers of shares by 2. Right? And you can see right here, now the total numbers of shares becomes 2, 4, 6, 8, and 10. Essentially double what they were over here. However, take a look at this. The share price is now half of what it was back over here, back without the stock split. The thing is that now you have double the shares. You own double the shares. You're not issuing shares because at this point when a stock split happens, the fundamental value of each share doesn't change because of the fact that you are multiplying the shares outstanding by a certain multiple, in this case 2, but at the same time you are dividing that share price by that same multiple, in this case 2. In a stock split, guys, the value of the company doesn't change. The value of each share doesn't change. In dilution of shares, because the company is issuing more shares without dividing that share price by that multiple that they're issuing shares, you're getting diluted. That is the difference between both of them. So let's take a look at Tesla's shares outstanding. They went from 2.58 billion to 2.7 billion, 2.8 billion, 3.1 billion, 3.15 billion, to 3.15 billion. The 1 year ago and the current year is just me trying to make the numbers work with the new year. But so just letting you all know that. If we were to take these shares outstanding, all of them, and we were to revert the 3-to-1 stock split that they had back in, like, I believe September of last year, don't quote me on that one. If we were to revert back that stock split, guess what? All we would do is we would take all of these numbers and divide it by 3. Guess what? You are still having an increase of shares, i.e. they are diluting you. That's how that works, okay? You're the one telling me to Google a dilution in stock split. But I am glad that you are an expert, seeing that you have been in the market since 2003. Thank you so much for your comment. And lastly, when it comes to the cash and equivalents, they currently hold $19.5 billion with an average of $11.6 billion. Now, when it comes to total grade, guys, this actually isn't that bad. Net income of 40%, free cash flow 60%, revenue 70%, assets minus liabilities 70%, cash flow minus liabilities 75%, and shares outstanding of 0%, for an overall grade, guys, of 52%. The biggest problem I see here is this net income as well as the shares outstanding. Now, when it comes to the net income, it's because of the jumps. I do not like those jumps. The shares outstanding, however, guys, they're diluting you. I know. Apparently, I'm wrong. They have never diluted you. It's just a stock split. But they are diluting you, okay? So that's why I give it a 0%. Overall grade, though, of 52, honestly, I thought it would have been lower. Tesla does have prospects in the future, especially if you believe this company to keep growing. And now for the part that this is where I normally get roasted in the comments section. Let's figure out, guys, if the current share price of $144.43, which by the way now is $150 post-market, is this a good price? Guys, okay, here we go. I'm going to assume, guys, revenue growth of 10, 12, and 14%. Now, I'm taking this from revenue growth tab here on Seeking Alpha, where they're saying that they're going to grow 50%. I have to be reasonable when it comes to these assumptions. I cannot believe that this company is going to grow 50% in the next 4 years. Absolutely insane. At some point you have to think, okay, they gotta have competition, right? And they do. A lot of these major car companies, Toyota, Nissan, Ford, they're also making electric cars, guys. They are. You don't think that that's going to come into competition when it comes to Tesla? Come on, absolutely. So I'm going to be fairly conservative. Again, I'm going to go 10, 12, and 14. Now for the projected share buyback. With the past 5 years, they have been issuing, within the past 5 years, they have been stock splitting 22%. So I'm going to say that they're going to continue to stock split at 15%, 13%, and 11% in the next 4 years. So it is going down, but not at the same rate, and it is going lower. Guys, with these revenue growths and these stock splits, we get the target share price of $17.89 to $21.19. Adjusting for debt, this goes up. You got to at least give them that. They do not have any debt, or at least very little debt. They go up to $41.12 to $48 essentially, with a margin of safety of 5, 10, 50%. This is between almost $35 to $45.54. You guys are looking at this and you're like, what? But the share price is $144 and they're even higher now. You're clearly wrong. The stock is going up right now. So, this is just going to continue to go up. What I love about that kind of statement is that it only takes into account this right here, this short-term gain of 5.5% post-market, and yet it ignores this drop from $384.29 on the 52-week high to $101.81, which happened 3 weeks ago. That is the part that just amazes me when it comes to that statement. Why is it going up? If it's supposed to be $40, why is it up right now 5.5%? Guys, stocks in the short term are a voting machine. Tesla is a very popular company. In the long term, 5, 10, 15 years, they are a weighing machine. They rely on their fundamentals. And if you don't believe me, again, you could say, yeah, but the stock is up right now 5%. They fell from $382 to $101. The funny part is that when Tesla fell to $101, people were screaming out of their minds. They're like, why is it falling? Oh my God, why is it falling? And I'm just like, yeah, it should fall. And now that it's up, it's just like, okay, everything is good. And it's just like, you think all the problems that made the company fall to $101 is gone in 3 weeks? Bro, come on. That's not even logical. So I'm still saying, and I'm going to continue to say, $50, at around $50 for a company like Tesla. Hate me all you want. Guess what? At the end of the day, the company still fell from 382 to 101. And if we see another drop like that and Tesla falls to sub 100, I'm going to make a video about it and I'm going to reference this one. And then I'm probably going to get a lot more hate from that too because, well, apparently stocks only go up. And that pretty much does it, guys, for this video when it comes to Tesla. Again, it's an expensive company right now. I'm not saying that they don't have a future. Their cars are awesome. Elon Musk is great, but the company is expensive. All in all, guys, this is what I'm going to make for this video. I know I said in the beginning I wanted to make multiple, but it's already getting kind of late and I do have to edit this. So I will put this one out, guys, pretty early in the morning. I would say at around like 8 a.m. But I will cover a lot more of these ones this weekend just because I do want to cover them overall. A lot of them I own, for example, Crown Castle and Nextera Energy, especially Nextera Energy fell a lot. I really do want to cover that. But for now, this is where we're going to end it, guys. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the new tech sites. Link in the description below. So with that said, peace out. And I'll see you all in the next stock analysis video as well as earnings report.